Hello, everybody, and welcome to IIE Financial's Education Series 4 of 4, Combination Options. And this is called Combination Options because we're combining selling options to acquire stock with selling options to distribute stock. So this is the fourth part of our series, and hopefully you've seen parts 1 through 3, or else this one may not make a whole lot of sense. So you definitely want to make sure that you have viewed 1, 2, and 3 in this series before watching today's session. Now, we started off with our first session really talking about the basics and the foundations, right, of what are options. And there's only two types of options. Those options are calls and they're puts. And then the other part is that there's only two actions that we can take with those options. We can buy them or we can sell them. Well, today we're specifically going to talk about selling options. And we're selling options as a way to generate extra income on positions that we would want to be in anyway as investors. Now, when we sell an option, we take on an obligation. And a lot of people are afraid of that word obligation, especially in the financial markets. But typically they get afraid of the word obligation because they don't truly understand why we would want to be obligated in the first place. And the reason we would want to be obligated is because we want to do something with the underlying security. If we want to own the security, it's okay to be obligated to buy that security. So we would sell a put. If we already own the security and we want to sell it, well, it's okay to be obligated to sell it at a given level, and we would sell a call. So as an investor, we talked about the 4 ways that investors can use options: stock substitute, stock protection, buying stock at a discount, and collecting extra income by being willing to sell the stock. Well, in our prior videos, we've actually spoken about each one of these individually. Today, we're going to talk about putting together strategies 3 and 4, which is why it's a combination option. Now, the thing to remember is that our most valuable asset that any of us have is the only asset that we can never get back, and that is simply time. I think we can all agree that there's no absolute guarantees in a financial market. We can't predict where the market is going to move. We can't predict when the market will move. We can't predict if the market will move, but we can accurately predict that time will pass. No matter what happens, time will always pass. And that passage of time is the way that we want to look to get paid. So in an option combination, what we're first going to do is we're going to sell a put. By selling the cash secured put, we are obligating ourselves to acquire stock. Now, in doing so, we're going to actually want to own the stock. So the most important thing is the underlying security and knowing we want to own the stock. Then we acquire the stock. Once we have sold the put to acquire the stock, if the price comes into our area, we will acquire the stock. And then a covered call will be sold to distribute the stock. And if I no longer own the stock, then I do it all over again and I sell a cash secured put to acquire the stock. This is a repeatable process that can be done on a regular basis that investors can use to enhance the income in their portfolios. So let's go through a hypothetical example and just kind of talk through the mechanics. So looking at this chart, let's pretend for a moment that this is a weekly candlestick chart, meaning each candlestick represents 1 week worth of time. So over the course of a month, we would certainly have 4 candlesticks. And let's just say theoretically that an investor has an area where he or she is willing to buy. Now, this investor wants to buy when price is at an area that he or she believes to be of value. We don't want to overpay for our investments. We want to get a good value for those. So instead of simply waiting for price to come down, the investor can sell a put to acquire the stock. Now, when that investor sells the put, the income from selling that put goes into the account immediately. Well, that investor now also is obligated to buy the stock at that given price, but they want that price anyway. Now, over the course of the next 4 weeks, which way can the market move? It can move up, down, or sideways. So let's just say that over the course of the next month, that the market basically goes sideways. It goes up for a week, down for 2 weeks, and up for a week. And at the end of the month, the obligation has expired worthless. The investor still does not own the stock, but the investor wants to own it still at that level. So what can the investor do? Well, he or she can sell another put to acquire the stock. And when they sell the put to acquire stock, money comes into their account immediately. Now, if the stock price goes down, they're going to buy the stock at the price that they want to buy it. But let's just say over the course of the next month that the stock does this and it goes straight up. Now, the investor still wants to own the stock, but the price has gotten a little further away from where the investor is really going to be able to get it. So the investor may find a new area where he's willing to buy. And rather than simply wait, this is a good time to sell another put to acquire the stock. So now if you think about it, the investor has brought in some premium 3 months in a row and still has not taken on the stock. The investor still doesn't own the stock, but simply by being willing to buy the stock, he or she has brought in additional income into their portfolio. Now, let's just say for the course of the next month that the stock does indeed come down, and we have 3 down weeks in a row. It comes into the level, and the investor now has to buy that ETF or that stock in that area. Well, the investor is now immediately going to put what we call the line in the sand. And the line in the sand is the point at which the investor has no interest in being in that security any longer. This is the protection. Now, the way we make money in any financial market is we buy low and sell high. So once the investor has bought the security, he or she has to have a position where they want to sell. Well, if that investor is willing to sell up at this top level, he can sell the call to bring in an additional income stream. Now, over the course of the next 4 weeks, let's say that the stock goes like this. It comes close to the area but doesn't happen. The investor now loses that obligation. The obligation is gone, and the investor has kept the premium. So now we're at 4 months in a row that the investor has received the premium, and once again, the very next month, the investor can sell the call again to get paid to sell the stock. Now, another side note to add is that during this period, if the stock pays a dividend, the investor would also receive the yield from the dividend. So we're talking about truly income investing, and we're adding to the income received from simply owning the shares. Now, over the course of the next 4 weeks, let's just say that the price goes up. The investor now is going to sell the stock for a profit, and he or she has received 5 months of premium as additional income for that security. And so what can the investor now do? Well, it can start all over again and sell the puts to acquire the stock. But what if it doesn't go up? What if the stock goes down? And now the investor is going to get out at that line in the sand and sell that stock for a small loss. So yes, that stock position will be done for a loss. However, maybe selling the options have brought in enough premium to cover for the loss from the stock. And then once again, the investor can just do it all over again and continue to sell puts. The idea here is that this income can continue to grow. So let's look at an example over a few months. And what we're going to look at here is XLV. XLV is a healthcare sector ETF for those that are unfamiliar. And this is a picture of XLV on 4/22. It's trading at $74.39 a share. So in this case, the investor wants to own the stock. So instead of buying the stock at $74.39, the investor is going to sell the May put. Now, mind you, we're looking at this on April 22nd. So we're selling the put that expires in May. Well, that's 66 cents a share. And at the end of the month in May, that stock is trading at $75.16. So the May put has expired worthless, allowing the investor to keep the premium, and he may still want the shares. So he's going to once again sell the put option, but this time he's going to sell the June put. Well, the June put brought in 53 cents a share as an extra stream of income. So if the stock goes down to 74, which is where we have that blue line, that's where the investor will receive the shares. The stock does not come down into that area, and on June 19th, the stock is trading up at $78.35. Well, the investor still wants to own the shares, but now he's willing to buy it at $77.50. So by selling the $77.50 put, which expires in July, brings in an additional 50 cents of premium. Well, it does not come down into that level, so it expires worthless. So we're now at 4 months in a row of these puts expiring worthless. And so now the investor says, well, I still want to own it. and selling the 80 put is going to bring in 58 cents a share of income. So over the course of the next few weeks, XLV comes down to 78.30. So now the investor owns the stock at $80 a share. That is where he has to purchase the stock because he was put the stock at 80. And the current cost basis is 78.30. However, in May, there was 66 cents. In June, there was 53 cents. In July, there was 50 cents. In August, there was 58 cents, for a total of $2.27 of premium received. Now, the cost basis of the shares is $77.73 a share. So even though the investor, was put the stock at 80, he got it at 78. The current price here is 78.30. The cost base is all the way down at 77.73. Now, the important thing to realize here is we've put a line in the sand at 77.50. So that 77.50 line of the sand means that the investor now has essentially 23 cents of risk before the stop loss would be triggered. But now that the investor has owned the shares, he or she can target where they want to sell those particular shares. So by doing this, the investor now owns the shares at the cost basis that he wants, and he's gotten it for a little bit of a discount. And overall, now the investor has owned the shares and he's been paid to acquire the shares. He can sell calls at an area where he's willing to sell it. Now, at the time of this recording, XLV was trading around $83 a share, which means that the investor had a cost basis of $77.73 a share, and it was trading up at 83. Whether or not the investor would still own it at 83 depends on where they would sell the calls to bring in extra premium and extra income into that portfolio. What this allows the investor to do is to continually stay engaged in the financial markets, but do so in a way that lowers the cost basis when purchasing these shares and increases the rate of return when selling it at the given target price. At IIE Financial, one of the things that we do is we help investors that are interested in using options in their portfolio. And if you're an investor and you're interested in utilizing options as a way to buy stock at a discount and collect extra income by being willing to sell the stock, give our offices a call at 832-953-4998, and maybe we can help you out. Thank you so much for listening to this. Please subscribe to the channel if you want to get a little bit more educational videos, and we hope you have an amazing day.